This is an introduction to the pairs trade and it accompanies interactive lecture notes that I've put online. So, the pairs trade. This is, I have a couple things pre-written up here. The first, before we get into how we're going to implement the pairs trade, we'll talk about what it is and the purpose of it. It's often called a market neutral or stat arb, statistical arbitrage strategy. So the market neutral means this strategy should not be correlated with the market. It's a long-short strategy. So ultimately in the pairs trade, we're going to go long one security, and I'm just going to say stock here. Usually this is done with stock. We're going to go long one stock and short another. So if we are running a pairs trade strategy and you took the returns from our pairs trade strategy and ran a regression on the market portfolio, market returns, then your coefficient shouldn't be your beta coefficient should be insignificant, not significantly different from zero. So that's what we mean when we say it's a market neutral strategy. That's why this strategy has often been done by hedge funds. Hedge funds one of the purposes of them is their strategy. Some should not be correlated with the market. So it's a place where you can put your money, and if the market crashes, you won't lose a lot of money in that portfolio. This is also called a stat arb strategy, and this is throughout here. This is going to be a loose use of the word arbitrage. So the idea here is we are going to look at some historical relationship between two stocks. We're going to quantify that relationship, and then in our trading period, if that relationship breaks down, we're going to bet that it reconverges. So in other words, we're kind of arbitraging a statistical relationship between stocks. It is not a real arbitrage in the sense that there's no guarantee that we're going to make money. So a loose use of the term arbitrage. So that's why we call this a statistical arbitrage strategy. So the basis of this is on the pairs trade, from a theoretical standpoint, is the law of one price and relative versus absolute pricing. So keep in mind what we're doing here is if we were to look at the value of a stock in absolute terms, so in absolute pricing, we would use discounted cash flows to say the value of this stock is $25. What we are doing here in the pairs trade is to price a stock relative to another stock. So what we're saying is, I don't know what the price of the stock should be, but it should be the same as the price of this other stock. Or you could have it should be some multiple of the price of this other stock. But the idea here is I'm just pricing this stock relative to another stock. This is used often in finance and economics. In particular, where I've done some research is on the relationship between crude oil and natural gas prices. So for instance, there's an argument that we should be able to relatively price crude oil with natural gas because they are to some extent substitutes. And so this relative pricing is based on the fact that one stock can be substituted for another stock. So think of and this is most easy to think of in terms of pure play companies. So if you think of, let's say you have two companies that both produce oil in the Bakken Shale in North Dakota, then those two companies can be thought of as substitutes for another, so that they should have the same price or relatively the prices should be related. So the idea is natural gas, the commodity, can be relatively priced relative to crude oil. So that's what we're doing here. We're looking for two stocks that are substitutes for each other from a basic standpoint. We're going to say substitutes. We're going to have a statistical definition of that, and then but we also, on a theoretical level, they should have. We're looking for stocks that are substitutes. So Coke and Pepsi, two oil firms, maybe major integrated oil firms, or just oil production, but we're looking for similar companies so that we can price them, so that they're substitutes and we can price them relative to one another. And this is, again, a loose, I have sort of an approximate implementation of the law of one price. the law of one price, again, in a strict sense, this is how we price options. So the idea here is the law of one price says if two securities have identical payments in all states of the world, then they have to be have the identical price today. And if they don't, you can arbitrage them in a real arbitrage. So what we're saying here is, when we move over to the pairs trade, is these two stocks pretty much have the same payoff in all states of the world, so they pretty much should have the same price today. So we're going to wait till that price diverges a little bit and bet that they return to their normal relationship. So again, loose application of the law of one price. So that's the idea of what's going on here. Stepping back, the nice thing is the pairs trade has been around since the 1980s. So there's a rich history of this. So you can look into where it started and see how it's been implemented. Now, before I get into the actual how in this course we're going to implement the pairs trade, I want to point out something that's good. There is no one way to implement the pairs trade. That's the idea. So the idea again is relative pricing, looking for close substitutes, defining the way in which they behave together, waiting for them to behave in a different fashion, and then betting that will behave as we statistically define them. Bet that they will behave that way once again. So there are a lot of different ways you can implement this, and this is an active area of research. So you can absolutely come up with your own ways, your own statistical methodology to define their normal behavior, and your own statistical methodology to define when they are not behaving normally, and then when to enter that trade optimally and when to exit that trade optimally. So there's a lot for you to do here. This is somewhat unlike Markowitz, where this is how we according to Markowitz, this is how we construct a portfolio. This is wide open. Now that I've mentioned Markowitz, one more thing before I get into the implementation. You can think of this as almost the opposite of Markowitz. Remember, in Markowitz, we constructed a portfolio by diversifying in an optimal fashion, but this portfolio held market risk. The one thing that we're doing, when I'm saying we're market neutral, long one stock and short another, is that we've gotten rid of market risk, and we only hold that firm-specific part. So this is a strategy like sort of the opposite of Markowitz, because we've gotten rid of all that market risk that Markowitz holds. Good. So talking about how we're going to implement the pairs trade, a simple version of the pairs trade in this class. This is an implementation that was done in a 2006 publication, Gatev and two other authors. And it's a very simple and straightforward methodology. But again, you can expand on this. And if I were to implement this, I'll talk a little bit about ways in which I would go in terms of implementing this. But this is a good way for you to understand what's going on. So now that I've said that, one of the things you might think is, if we're looking at pairs and we're going to define how they behave and if they behave similarly, if you've taken a sufficient amount of statistics, econometrics, what might pop into your head is we could use co-integration. And that is absolutely true. We could state this as we could state what we're doing here in the pairs trade as something like, I look for co-integrated pairs. Co-integration means there's a linear combination of these stock returns in which the error term is stationary. If two stocks would be co-integrated, I should say a linear combination of the prices in which the error term is stationary. If two stocks are co-integrated, then we can write them in error correction form, such that if there's a shock to the spread between those two stocks, then it will be corrected in subsequent trading periods, and the error correction model will give us how quickly it will be corrected and so forth. You could also think of this strategy in terms of mean reverting stochastic processes. So in other words, you could state that the spread is a stochastic process with mean reversion, estimate the rate of mean reversion and so forth. So these are the definite avenues in which you can go, and many have gone in terms of quantifying the relationship between pairs. However, what we're going to do, and what Gatev in 2006 did, was set forward, which is consistent with co-integration, but set forward a very simple algorithm to implement the pairs trade. So what we're going to do is first, and these steps are sort of circular, first choose a set of pairs. Now, in their paper, they actually, I think they did it both ways. They just searched on the whole universe of stocks, matching pairs that theoretically may not match. So in other words, they might match, DDD 3D printing with JP Morgan, right? There's no theoretical basis that those two should be substitutes. And then they also only match pairs in between industries. In general, particularly for this course, I would recommend that you start choosing pairs that are in the same industry and you don't search among the whole universe of pairs. So the idea is what we want to do is we want to choose pairs that, that should make sense. So the idea, again, Coke, Pepsi, JP Morgan, Goldman Sachs, BP, Exxon. And then we want to see if they, we're going to have two periods here, estimation and trading. So over this, what we define as our estimation period, some period, in the history, we want to see if these have behaved like a good pair. And what I mean by a good pair, it's easy to look graphically. These are going to be normalized prices. So the idea of a normalized price is I calculate returns, and these are just cumulative returns. So the difference between the cumulative price at any 2 points is the percent return there. It also allows me to put two stocks on the same scale, whereas one stock might be $200 and one might be $5. So first thing is calculate the normalized price, and if this is normalized price, this is time, this is normalized price up here. A good pair is going to do this. They're going to stay together, and then they're going to break apart, and then they're going to snap back together, right? Stay together, break apart, snap back together. So the idea here is, first we choose the pair, we calculate the normalized prices. And my interactive lecture notes are going to do this for you for any pair that you input. Then we calculate, I have ASD and SDSD, so the average square deviation and the standard deviation of the square deviations. So what we do is we just calculate the deviation here and we square it so that they're all positive, and it doesn't matter if one stock is higher or the other stock is higher. So we calculate these deviations and square them. Right? Calculate these deviations and square them. So this will give us sort of the average square distance between the normalized prices, and then we get the standard deviation, so the variability of the spread. So, and you could kind of, to visualize it, you could say that this is the spread, so this is time, and this is the, the square deviation. So here, square deviation would be low, square deviation goes high, square deviation is low, square deviation rises a little bit. So this is going to give us the standard deviation, how much variability is in this. And these are the two parameters that we are, one, going to use to rank pairs. We want to choose pairs where the square deviation is low over long periods of time. So this is going to allow us to rank these pairs, and then we're also going to use these two parameters in our trading period. So what we do is we choose pairs, calculate the normalized prices. This is our metric of if they behave similarly, and then we sort of rank them by how similarly they behave. So in other words, what we want to get is, particularly in this, in this project, in this course, I'd recommend at least 20 pairs, because you want to have enough pairs to trade, and you don't want any pair to be a very large part of your portfolio. Ideally, a pair may take up 5% of your portfolio. And to have 20 pairs trades on, you probably need, you need well over maybe 100 pairs. But for us, I try to get 20 decent pairs. So the idea here is you're going to choose pairs and rank and see how closely they behave. Rank them. Look at how relative to other pairs. Maybe JP Morgan and Goldman Sachs don't turn out to be a good pair, so you throw it away. Then you look for another pair. So you kind of do this until you get 20 decent pairs. Again, decent from a theoretical level, decent from a statistical level in terms of small average square deviations. Once you have your universe of pairs that we're going to trade, we go into our trading period. Now, the one thing to keep in mind is this trading period is after the estimation period. The periods don't overlap. So in other words, don't use the parameters that you've estimated here, don't use them in the same period in which you're estimating them, right? So we have our parameters, and then we go to a later time period, and then use these parameters that we estimated over the estimation period to trade in this period. So again, in the trading period, now we have, for each pair, we have the definition of their behavior, and we watch them. Again, in this space, we have time, we have the normalized prices, and we watch them. So let's say, I'll give these names. This is Goldman Sachs and this is JP Morgan, right? So let's say all of a sudden JP Morgan tanks and Goldman Sachs goes up, right? So the spread diverges. Now, we have something to decide. One, when do we enter into a trade? So I have, what we do here is enter into a trade when it's the normalized prices are the squared deviations of the normalized prices are X standard deviations wide. The paper uses 2 standard deviations wide, and they close the trade when when they cross, right? So when the normalized prices equal each other. That's not to say you have to do that. You could enter into a trade when it's 2.5 standard deviations wide and close the trade when they're 0.5 standard deviations wide. That's your choice. For now, here I'll note that the text says 2 and then close the trade when they cross. So let's say here at this point the spread is the squared spread is 2 standard deviations wide. So right now this is Goldman Sachs and this is JP Morgan, right? Because they've crossed, since I've said. What we're going to do is we're going to buy JP Morgan and we're going to short Goldman Sachs. Now the question here is, of course, trade size. How much should we buy? Again, the idea here is so long as their betas are almost equivalent, you would want to buy an equal amount that, so if you bought 10,000 worth of JP Morgan, short 10,000 worth of Goldman Sachs, if they have vastly different betas, one, consider whether they're a good pair. But if you still think they're a good pair, you could weight the trade by the betas to cancel out the beta. But the idea here is when you go long short, you should be canceling out your beta. We buy JP Morgan here, we short Goldman Sachs. If it gets a little bit wider, we're losing money, but we hold this trade and we wait until they cross again. So we exit our trade here, right? So in other words, we bought JP Morgan, we sell JP Morgan, we buy Goldman Sachs. And then we wait again, and now let's say, the time goes on and they stay very close to each other, and then all of a sudden we have JP Morgan goes up and Goldman goes down, 2 standard deviations wide, buy Goldman, short JP Morgan, wait till they converge, and rinse and repeat. We do this over and over and over. This is very nice because it can be automated. You can just have a computer running that triggers these sorts of things. But now that I've mentioned that, one thing to keep in mind is you can't do this purely without the human element. For example, we might, and I touch on this in the lecture notes, keep in mind we have 2 distinct periods here. So let's say all of a sudden you have back before the Gulf oil spill, you're looking at JP Morgan and Exxon to be a pair. And all of a sudden the oil spill hits, right? Well then, keep in mind, the oil spill hits in your trading period. You're going to see BP go very far down relative to Exxon Morgan. Relative to Exxon Mobil. Now, that doesn't mean enter the pairs trade. You stay away from the pairs trade at that point because these distributions, how we estimated their behavior is not going to be similar to how they're behaving now. In other words, you can think of a regime change, right? So, in other words, what you would see is the spread blow out to be 20, 30 standard deviations wide, and again, you would want to not touch that. So in other words, keep in mind, there is a human element to make sure that there is no fundamental reason for the spread to be this wide. If there is a fundamental reason that that wasn't contained in this estimation period, then you would want to leave the pairs trade alone. So it does require you to every once in a while investigate why the spread is so wide. If it's something as obvious as a Gulf oil spill, stay away from the trade. Good. So is there anything else I want to note here? I think that's it. What I'm going to do is I have the interactive lecture notes. I will do a screencast and show you how to use the interactive lecture notes. But I think this will get you started in terms of or understanding what you were going to do. Lastly, I'll say I noted that you might get a spread that's like 30 standard deviations wide. Note that is very unlikely due to Chebyshev's inequality to see a get something that many standard deviations wide, but that assumes that it's coming from the same distribution. Keep in mind here, stock prices over time, the distribution changes over time. So you might get wide spreads here again because the distribution has changed. The distribution of the relative prices has changed from the estimation to the trading period. Good. Trading period, trade size, excellent.